Saturday, July 28th, 2018. Hard to believe that July is almost over and summer's coming to an end. Here in Indiana, there's some of the schools actually back in session. Roman and Leo go back in a couple of weeks, so we're trying to make the most of the end of summer. Can't let break go by without having a little bit more fun. Well, it's another Saturday, so you know that means it's time for your weekly mixtape and your weekend review video, so thanks for tuning in. A busy week, so let's get started with some economic news first. On Friday, the GDP report came out and it showed that the U.S. economy grew at a rate of 4.1%. That's up from, let me check, up from 2.2% in the first quarter. So a 4.1% growth rate. Obviously, we want to see that number going forward, so it's a good number. It's the fastest rate in 4 years. So the economic picture looks good and that the economy is still growing at a good rate. We'll have to see if the tariffs that kind of got rolled out this second quarter impact third and fourth quarter growth. So we'll see how that plays out. There was an interesting number that I saw and I wanted to point out. It showed in the report that personal savings went down from 7.2 to 6.8%. So not a huge drop, but that's a rate that as a planner I would prefer to see stay steady or even incline a little bit and go up a little bit. There's an article that I'll link to in the mixtape that actually talks about the need to save more to offset maybe lower stock market gains, but maybe the point is just saying if you save more, your reliance on the stock market goes down. And I've shared an article about that before, but just seeing that personal savings rate go down made me think about this article I saw in the Wall Street Journal this week, so I'll share that in the mixtape. But that'll be a number I just kind of monitor to see, is spending heating up, and is that setting things up for something we don't want to see in the economy. But overall, good report regarding the U.S. economy's rate of growth. And sticking with the economy, the White House has announced a $12 billion farm aid package plan to help farmers that are beginning to feel the impact of the tariffs and trade war, if you want to call it that. Interesting note, I think that it's it's a pretty hefty aid package, and I definitely want to see farmers getting help and don't want to see our farmers struggling. But I just find it interesting that the need to help farmers is a direct result of the tariffs and the way that the White House is handling the trade disputes. Whether or not this ends up being the right way, I don't know. I'm just little old me in Indiana doing my thing with my clients. I'm not the smartest person in the world, so I don't know if going about trade is the way we're going is the best, but we're seeing an impact on the farmers, and it's actually going to be costing U.S. taxpayers to help them out, which I want to see them have helped out. But again, the whole point was just the trade war brought this on for new need, for new expense for our government. Let's check out what we had next. We're going to stay kind of in the trade area. So the trade disputes, tariffs, that's still going on with China and some of our other partners, but it did appear as if after a meeting with the EU, the US and the European Union are going to at least stop with future tariffs while they talk things out. So it seems that maybe we're heading in the right direction with one of our trade partners, but there's no date set for when this conversation is going to be completed. So maybe it's just a headline to look good, like a small victory for our side or their side. Who knows how it's actually working, but that is the headline, that the EU and the US are going to be trying to set aside their differences and hopefully put this part of the trade disputes to the side, and we can move forward working on others. It was a busy week on Wall Street and a illustration of why individual stock picking is such a hard thing to do. So we're in the middle or early parts of earnings season. This past week was a big week. You had Google, Amazon, Facebook, Twitter, and a bunch of other companies reporting. I highlight those because those are the ones that people always want to talk about, but also because they were the ones that had some of the biggest moves and biggest reports. So technology has driven the stock market over the last few years. I'm not at least saying that we're in a tech bubble or anything, but if you look at where the growth has come, it's been led by Google, Facebook, Amazon, Netflix, these bigger tech companies. Well, we're starting to see maybe there's a shift at least, or a slowdown in tech. Who knows what this ends up being, but anyways, those companies reported. Facebook and Twitter did not have good reports. Google and Amazon did. And I highlight this not to make recommendations, so don't go out and try to buy some of these stocks, but I highlight this because this illustrates why it's so hard to pick individual stocks. You can make great cases for all those companies, but as an investor, and a small investor like we are, we have no idea what's going to come out in these quarterly reports. And there's such a focus on quarter-to-quarter earnings, which keeps everything so short-sighted. And one bad quarter can have a 20% drop in one day. So Facebook announced they're guided down, meaning they're expecting their future earnings, future usage time to be going down. Probably fallout from some of all the Cambridge Analytica and some things going on from security and personal information, but they're expected to go down. And the stock plummeted 20%, and that was the largest one-day loss in terms of dollars. Facebook lost $119 billion in value. If you go out, you can find articles telling you what companies that makes up, like Facebook lost a Nike and a so-and-so and so-and-so all in one day, but a lot of money was lost on the stock market in one stock in one day. Same thing with Twitter. They came out, and I want to highlight this one, again, why it's so difficult to pick individual stocks. One of the big things that drove Twitter down was their monthly active users. So this is a metric that when it comes to social media companies, Wall Street looks at. How many people are using it on a monthly basis? How long are they on it? Just to try to determine how much usage is out there. Well, if you remember back maybe a month or a few weeks ago, I discussed on one of these videos that Twitter was actually going to be getting rid of a bunch of fake accounts. Your fraudulent accounts, accounts doing negative things, they were going to weed those out, and it was a pretty substantial number. Well, naturally, if those accounts are weeded out, then there's going to be fewer accounts being used on a monthly basis during this quarter. Should have been a big shock. Now, I'm sure there's other factors. I didn't read the report, I didn't read all the analyst stuff because I don't spend time on that, but if that was known, not quite sure why that wasn't expected. And I look at Twitter, everybody knows I'm a huge fan of it. If we're getting rid of those bad monthly active users, quote unquote monthly active users, then the quality of the users goes up, and I think quality is better than quantity. You can have a bunch of fake accounts to make the numbers look good, but if they're not being used, what value is there? I'd rather have smaller number of people using it, being engaging on it, using it properly. I think quality over quantity is a better metric. Wall Street didn't agree, so the stock got plummeted, or got hit. So again, the whole point of bringing this up and highlighting these companies is, for most people, picking individual stocks is not the best way to go. It can be very volatile. 20% in one day, that's a lot of a percentage loss in one day. Hard to stomach. A diversified portfolio is going to give you those companies in your portfolio. You'll have exposure to them. You'll be able to participate in their growth when they pick it back up. But if they have a bad day, it's not going to blow your portfolio up. So I know I've gone on a little bit of a rant in this weekend review, but those companies reported. We're going to continue to have earnings report. We have another big week coming up, so you're going to have a lot of headline news about certain companies, and then also you're going to have pundits trying to make predictions that, well, because Facebook and Twitter had trouble and Netflix didn't have a good report, that maybe tech is crumbling and the stock market is going to fall behind it. No one really knows. Those are arguments that are valid, but we don't know. They could turn things around and move forward again. So not that you can't do well investing in your portfolio with individual stocks, but if the level of risk that's associated with them and looking at what happened this week doesn't make you feel good, you're not comfortable with it, then stick with your diversified portfolio. Over the long term, it's probably going to hold up pretty well and do well for you, and you're going to be able to sleep a little easier at night, not worrying about earnings tomorrow and what's going to happen to my stock. And then on top of that, more headline news on individual stocks. You have Tesla in the news. Elon Musk has been in the news the last few weeks just with his antics on Twitter, and a lot of talk about Tesla as a company. Well, it came out that they asked for suppliers to return cash to them so they could show a profit. And I've read that that's actually kind of a normal process, but it's not a good headline, and that impacts the stock price again. And then you have an instance like Papa John's, where the owner mouths off on a call, drops a very negative word, ends up being ousted, rightfully so, but doesn't want to give up his stake in the company and wants to still be a part of it. So now you have this battle in court, this battle in the news on individual stock that individual investors like us, we have no impact on that company. We're trying to build a portfolio to grow our money, and we're impacted by the actions of others. Make a case, that's the case for a diversified portfolio. Take away all that headline risk. Well, take away a lot of the headline risk, take away a lot of the individual stock risk, and be able to focus on other areas of your life and enjoying the time with your family, enjoying the end of summer and not what's going on in individual companies, and just let the overall market do the work for you, which historically has, and I believe will continue to do that. Otherwise, I'd leave this business. So a long rant. I apologize. Maybe I should have made that a rant on its own and did a new type of video. But that is it. That is this week's Weekend Review video. Be sure to check out the mixtape below. It is stacked with a lot of great writing this week. If you're watching this on YouTube or Instagram TV, head on over to allaboutyourbenjamins.com. Check those blog posts out. Again, it's got a lot of great stuff this week, more articles than usual just because there was so much great writing going on. So thank you for watching, and we will see you in the next episode.